Well, I'm really excited today to have Robin Barrett with FSW. I'm really thankful for her to come on. She's going to be talking about her company, what they focus on from the financing perspective. They're in a different space than we are, and it's an area that I think we want to give some attention and focus on, obviously now and even in preparation for when things slow down. And so I'm just really thrilled to have her on. And so she's going to spend some time walking us through her company, her process, how they go about marketing and some of the areas that can be potential opportunities for us. And so thank you, Robin, so much for coming on, and I'll hand the baton off to you and let you tell us about what you are all up to.
Awesome. Thanks, Dave. Thanks for having me today. So I am the managing member of FSW Funding. I started the company 21 years ago. I own the company. We started out as a local lender, asset-based lender. And over the years, we've kind of grown now to actually having clients across the US in just about every industry except for construction, healthcare, and single carrier transportation. So we will look at logistic companies or freight brokers, but we're not going to do the single carriers. And just real quick, we'll probably do anything. We will look at startups as long as the management has some experience. So we'll start out with small deals selectively, and we can go as high as 10 million. So real quick, I'm sure most of you guys are familiar with bank financing, correct?
That's correct. Yeah.
Yeah. So banks are 100% cash flow lenders. So, when you present a package to the bank's going to look for 3 years of financials. They're going to want to see positive cash flow, positive equity, and actually pretty positive, or pretty consistent earnings. They don't want to see the, it jumps up, it jumps down, it jumps up, it jumps down. So banks are really good for established companies with established positive cash flow. So that's great for a lot of the companies in this world. So asset-based lenders, we are looking primarily at the assets of a business. So for example, I will look at a client and the first thing I would ask for would be their accounts receivable or their balance sheet and income statement. I'm not so concerned about them making money because there's many reasons, and we'll talk about that, why they may not be making money, but they're still a great candidate for us. So kind of the takeaway is banks are cash flow lenders, and then asset-based lenders like myself, we're looking at the assets. So that allows us to be a whole lot more flexible, and it allows us to offer financing to a huge amount of companies that banks just can't service. So when we talk about it, and I've got my presentation over here that I'm looking at, when we're talking about good candidates, so you probably are thinking in your mind, you've got a few in mind, startups, right? Again, like I said, where maybe you've got people that are branching off from another company, or they've been in the industry and they're a startup. So again, no cash flow and no history, but they come to us, and if they've got contracts and they can start invoicing and they can start creating assets, we can fund their growth. Negative liability, tax liability issues. So for example, you've got a company that, and this happens unfortunately a lot, small business owners get into a little bit of a cash flow problem, and they think that it's probably okay to borrow from Uncle Sam and not pay their payroll taxes and think that they can just pay it tomorrow. I'm going to use that payroll tax money today that I withheld. Business will pick up and I'll pay it tomorrow. That never happens. And then all of a sudden you've got a client that's got a tax lien issue. Tax lien issues are like the death sentence for most businesses. Banks won't touch them. We are able to go in and usually work with them to find solutions so that we can get a subordination from the IRS and then fund that company so they can continue to pay off the IRS over a period of time and continue with their business. So that's one. Negative equity. So that would happen if you've got an owner maybe who's taking most of the equity and income out of their company each year and not leaving much equity in the business. Banks like you to leave equity in the business. But I'm sure you've all met business owners that it's basically a lifestyle business and they're really not keeping much in the business. So where there's little equity or even negative equity. So for example, they might have had some losses in the past. Again, banks are cash flow lenders, don't want to touch that. We can look at it because again, we're looking forward. What assets do you have? How are you going to grow? How are you going to continue to improve your company? And we'll take a gamble on that and we'll finance you. Turnarounds. So, that's kind of like what all the above are, right? The negative equity, the tax lien issues, negative cash flow, all of those are turnarounds. So we're brought in a lot of times by the C2 CFOs or by bankers or maybe accountants or attorneys that say, hey, I've got a client who's got an amazing list of customers. They've got an amazing product. They made some bad mistakes historically, but they're a good company. The bank's kicking them out. Their lender's kicking them out. Can you take a look? Absolutely. Now, here's a couple, fast growth. So we've had companies that have come on and gone from, let's say, like staffing companies, especially in the healthcare staffing right now, where they'll start off with maybe doing $100,000 a month in AR to doing $1 million a month in AR. So again, when you think about banks are looking at the historical information, the historical cash flow of a business. And that's how they're coming up with what their line of credit or their loan is, credit limit is going to be. Asset-based lenders like myself can say, look, I don't care where you were yesterday. I'm looking forward of where you're going. And if you've got contracts in place and you can create, revenue and receivables, I will continue to grow with you. We also don't have problems, like that banks would normally have with concentration of customers. So again, we'll kind of go through that a little bit later. And then the last one that's a good candidate for asset-based lending is seasonal businesses. Very good example right now is we're looking at a prospect that sells Christmas ornaments, right? So they got to build up all of that inventory starting in August. So they got to build up all of that inventory and they ship all that product out by usually October. So they've got the inventory number has to go up first. So we have to lend on the inventory. And then the AR comes in, we pay out the inventory loan, but now we've got that spike in AR. And they're seasonal. It happens once a year. So again, banks, it's difficult for them to be able to create a credit facility that has that kind of spike in the middle, or maybe a couple of times a year. So again, we're a good candidate where a bank would not be a good fit because we're going to look at the future and not the past of the business. Now the process. Our process is very fast as compared to a bank. We can close a deal from start to finish in as little as 5 days and usually no more than 1 month. And the 5 days is usually one, if it's a startup, two, if there's, as we all know, no hair on the deal, right? It's a pretty clean deal. They come to us, we can close it. No lien issues, we can close it in 5 days. What is required items that we're looking for? And we'll talk about, what you guys are going to kind of look for, but all we need, first of all, you could just send me a name and a number, and that's fine too. Basically, the only thing that I would ever, if you called up and you said, hey, I might have a candidate, what are you looking for from me? Send me the AR aging. Send me a detailed AR aging, and I right there can know if we can do the deal. Oh. Again, we are asset-based lenders. Our credit facility, our credit limits are all determined on the credit worthiness of our clients' customers called the debtors. So if you send me a deal and it could be, they've got a good, maybe it's a turnaround and they've got some, equity coming in and all that, but their debtor base, who they're doing business with is small mom and pop restaurants. Maybe they're selling, popcorn to those or something like that. We can't do it because you just can't pull the credit on those small mom and pop restaurants. So really that's kind of all we're looking for. Now, for you guys, when you're out there and you're talking to businesses and stuff, obviously the key words that you're going to hear that would be probably a good fit for us is I'm having cash flow problems. My bank can't grow with me. My bank is kicking me out. Or, you know what, I can't qualify for a bank loan for some reason. Most businesses will always go to a bank first to try to find financing. Once they're turned away from the bank, they don't know where to go. They don't know what their options are. So let's go back to the process. Once we have, let's say you just send me a name and a number. I'm going to call that prospect and I'll know within 5 minutes if we can do the deal. I'm going to find out what industry they're in. And I'm going to ask them just, a question like, okay, who's your top 5 customers? And what are your terms that you sell on? So with those 3 items, I can figure out if we can do a deal. After we know we can do a deal, what we like to do is we like to send a proposal out right away, within at least 24 hours at the most. The idea is that if I can get a proposal in front of a prospect, mentally, they're going to stop shopping the deal. They're going to, if they sign my proposal, basically they're probably going to stop looking. So our process is get that proposal out to the prospect as soon as possible, get them off the market. After we get the proposal in, then underwriting, as I said, can take anywhere between 3 to maybe 30 days. And underwriting basically consists of, we get an application in, we do a background check on the owners or the principals. We do lien searches. We're looking to see what UCC ones are filed against the company. That's going to kind of tell us really how long the process is going to take. If you've got a company that has 3 or 4 UCC ones in a first position or they're in a secured position, then we're going to have to figure out how to get all of those UCC ones subordinated to us. And that takes the longest. It can be the biggest holdup. We do background searches on guarantors. We love to get personal guarantees. We don't always get them, okay? And obviously in this market right now, it is still a very competitive market out there. PGs are hard to come by. I will push to get them, but if we have to, we will accept what's called a validity guarantee. And the validity guarantee is basically that, the owners or the CEO or controller isn't going to commit fraud. And if they do commit fraud, then it turns into a personal guarantee. The next thing is like what we talked about is we spend a lot of our time doing the research on the credit of our prospects' customers. Is it Rite Aid? Is it Walmart? Is it, Bob's gas station down the street? So we spend a lot of time going through and doing the credit research and then figuring out how much credit we can give to each of those debtors. We want to make sure that when we sign up a prospect that we can meet their expectations, that we will be able to finance their growth. I looked at a deal in the healthcare space, and I think it was Genesis Healthcare, and they were having some serious financial problems. And while it's a big company, I was very concerned, and I was honest with the prospect. And I said, I'm not going to get you to the number that you need. It was 100% concentration. I said, I just don't feel, unless you had credit insurance, I'm not going to take the gamble. And that brings up another point. We can, for example, if we have a client that has maybe credits that are international or that are smaller and you can't get the information on them, we will sometimes ask our clients to get credit insurance. And we work with several brokers that can help us do that. And basically that just helps us build a credit file and also kind of takes a little risk off of us in terms of those debtors paying timely. The next thing we do, or the second to last thing we do, is we verify the AR. So before we're going to fund on a client, we're going to make sure that the accounts receivable they sent us is true and accurate and still outstanding. So we will verify either one through online portals. We may make phone calls. We may do emails, but we're going to verify that those assets are true and real. And then, because remember, we're not relying on the cash flow of the company. Our form of repayment is off the conversion of accounts receivable to cash. And if I purchase accounts receivable that's fraudulent or not there, then I'm going to lose money. The last step in the underwriting process is basically preparing and sending out legal docs. So our legal docs are pretty standard. Nobody likes to sign legal docs. We can negotiate them. Again, I am probably not going to negotiate them very much. I will have prospects tell me every single time that our contracts are very one-sided in my favor. And I said, absolutely 100%, because I'm putting the money out. So that's kind of how it goes. We haven't had much pushback on the legal docs ever. A few word changes here and there, but that's about it. So to wrap it up, how can we help, right, a company? And why are we a good candidate for some of these companies? We're fast. We are fast to respond. Once you guys send us a deal, it's not like some bankers you deal with who are like, yeah, I'm going to go play golf today. I'll get to it like next Thursday. No, it's a call to action. We are going to call that prospect. We're going to make communication. We're going to let you know right away also whether one, we can do the deal, or we think we can do the deal, or two, we can't do the deal. Assuming we can't do the deal, we're going to tell you why we can't do the deal. It just helps educate you too. If we can't do the deal, but we think we know somebody else that can, we're going to give you the name of that lender. Maybe it's somebody who doesn't need accounts receivable financing or inventory lending, but they need purchase order financing. Maybe they need just inventory lending. Maybe, maybe they need a term loan and there's not a lot of collateral. So we know some other players. We know a lot of other players in the space, in the asset-based lending space. And we're more than happy to say, hey, Dan, we can't do the deal, but here's like 3 names or 2 names or 1 name of somebody that I am pretty sure they can help you. So for example, we don't do healthcare finance, but I know 3 or 4 lenders at various levels that will do healthcare finance. And I'm more than happy to put you in touch with them. We also, again, we have the fast underwriting. We can do a fast close and more liquidity than a bank can give. We will give usually higher advance rates than a bank will give because we're really looking very hard at the assets and the conversion of the assets to cash versus the cash flow. We have flexibility on ineligibles. We talked a little bit before about how banks are going to look at concentration. Banks don't like to have a customer or their client to have concentration with any one customer more than usually 25%. Usually it's 20%. We have some customers that have 100% concentration. Again, because we're so close to the assets and we're monitoring those assets every day, we can have the flexibility and we can make those seemingly ineligible accounts receivable eligible. So it helps a lot of companies that normally wouldn't be able to get the bank financing. We can also finance on government contracts. Banks do not like government contracts. The reason being is you have to go through a very tedious and long process with the government to be able to fund on government AR. It's called the Federal Assignment of Claims. And we are experts at it. So we do we have a lot of clients that have government contracts. We can also offer some solutions, like when we talked about the seasonality of doing an over advance. So for example, we have a client we know that is that sells just, Christmas ornaments, and they've gotten their inventory in and they still have a need. Maybe they have marketing or something else and they need a little bit more. We can do what's called an over advance. So if we're advancing, let's say 85%, we may give them a 25% over advance for a short period of time to get them over that hump. So again, we have a lot of flexibility in what we can do. And the better we know our client, the more flexible we can be. So for now, let's see, before we kind of talk about what issues are ahead, do you guys have any questions on maybe the difference between banks and us, or any other questions?
Yeah, go ahead, Dan.
Oh, yeah. So Robin, I want to thank you for taking the time to do this. I have actually experienced working directly with Robin and Nick over there, and they're fantastic. Also, one thing to note is what I kind of picked up on as well in my experience working with you guys is that you can kind of be that transitory kind of partner where it's like, hey, we're not ready to be bankable, but we'd like to be. And that's something that you guys do a really good job filling that gap, even for clients that are just kind of starting up to get to that point. Is that pretty accurate too, Robin? Is that kind of, yeah. I mean, obviously our success is measured probably by our clients leaving and going to a bank. And we are good for clients that are maybe have fallen out of formula with a bank. They'll come with us, they get back into formula, they'll go back to a bank.
So in terms of flexibility, again, we can go month to month. If you bring us a client and you're like, hey, look, they had a little hiccup, they're going to be fine after 6 months. The bank wants them out for now. The bank will look at them after they've got, maybe, year-end financials. Then we can do that. So it saves a client a lot too, because they don't get like into a long-term contract. Okay. We also won't do monthly minimums. So a lot of asset-based lenders will require their customers to fund a certain amount each month. Again, that can be very expensive if, like, for example, in COVID, a lot of borrowers found that they had some real issues and their lenders were not waiving the minimum monthly minimums. So you had a lot of borrowers that were paying a monthly minimum and not borrowing much at all. So, again, we try to work with our clients to bring up something very flexible, but you're right, Dan, we are a good transition. We're a good bridge. We are not a good long-term solution because our money is going to be more expensive than a bank.
Yeah. So yeah, Robin, this is great. What is the, so I understand, kind of asset-based, looking at the balance sheet, clients aren't really going to make payments per se, I suppose.
Well, yeah, and I'll tell you how that works.
Yeah, I was going to say, if you could walk through, like, how does that pricing structure work? So
again, with cash flow and the way that banks price a line of credit. So banks are pricing lines of credit probably anywhere between, let's say LIBOR plus or a prime rate. So it's anywhere going to be like a 3.5 to maybe on the high level, 7 or 8%, right? Banks don't have, they do the cash flow deals, they do the safe deals because they aren't really doing loan administration. They let the clients collect. They basically get paid interest each month by the client off the client's cash flow. Our clients may not have cash flow. So we control the cash, meaning that when we go in, we're either going to have a DACA account, which is a direct access control account with a bank that gives us exclusive control. So all of their customer payments go into that DACA account and then go to us. Or we have what's called a notice of assignment letter. And the notice of assignment letter is controlled or regulated under Article 9 of the UCC code. And the notice of assignment, once a debtor or a customer gets it, they can no longer pay any other party except for FSW. If the customer pays our client instead, then they call that pay over notice, and the customer still owes the money to us. So it's a very powerful tool, but it allows us, Dave, then to maybe offer some more flexibility because we are controlling the cash. Yeah. So we collect the cash. So we basically will hold back our fee or our interest from our clients. So we basically remit to them everything but our interest or our fees.
That's great. And I know we've got probably 5 minutes or so. What would you say is the best way for the associates to market? Like, should they go to banks? Should they just, what would be what's the best areas to market for this stuff?
Yeah, I think it's kind of where you're going now. It's banks, it's CPA firms, it's probably tax attorneys or turnaround attorneys. Again, or you're meeting with businesses. The key words are, I've got a client that's having an issue with their lender. I have a client that had a loss last year. I had a client that was affected severely by COVID. Any of those things, anything where it's like, hey, something's up with the client and they might need a little bit of help. That's something that's really kind of like our call. I don't know. I'm going to send Dave a marketing piece that'll have all of Nick's information on it. You can talk to banks about it, but I wouldn't. If you guys already have the relationships, and it's just basically listening to your bankers and stuff like that, and just saying that maybe just saying, hey, if you have any clients that are having issues, we might have some alternatives for them. And I think that's the same kind of conversation with CPA firms or attorneys. Hey, if you have any clients that are having some issues, we might have an option for you.
That's really good. What other questions do you guys have for Robin around this product?
So Robin, quick question. I've heard in the past, like with your with your service, they can select which, if it's factoring, the client can then select which ones they want for the AR, which ones they can factor or not.
Yeah.
Is that not common, or is that kind of a competitive advantage you guys have where other groups would require they factor everything?
Again, we could have like a 3-hour discussion on pricing and structure, because everybody is different. Again, we try to go in there and be the most flexible. We have some clients where they will only factor certain invoices. Part of our process when we're talking to a client is really to understand their need. What are you trying to achieve? What do you need this cash flow for? So we try to educate them on the process so that they can reduce the amount of fees or interest that they're paying. We do have clients that fund against all of their invoices. So it's, all whole account turnover. So again, we can be very flexible. We have some clients that we have a client that does work or has a line of credit with a bank. The bank was not able to give them enough credit on one of their customers. So they contacted us. We did an intercreditor with the bank. We carved out that customer and we funded that customer. So that's the only customer that we do for them. And it was a great win-win for the bank because the bank kept the client. It was a win-win for the client because they were able to go outside of their bank and get credit for this customer. And it was a win-win for us because we've actually gotten another debtor from them, or another customer from them. So it's good.
That's great. So it sounds like, asset-based lending, real quick turnaround time. Somebody is in a cash flow crunch of some sorts, but they have the assets, the receivables for us to be able to go into, and marketing to banks, CPAs, attorneys, obviously existing clients. And I'm imagining that it probably picks up even more so when the market turns. We'll get into cash flow crunch. And so, we would love to start partnering with you and providing some of these opportunities. I think this will be great for us to now understand what it is that you do and now be able to keep our antenna up for those opportunities and then circulate those to Nick Broderick. And so we really, really appreciate you guys. We like, that partnership of quick turnaround time, quick responsiveness, low red tape, that fits our model really well, and the proactiveness. And so thank you so much for coming on today and sharing your company and your process and how you guys do business over there. We really appreciate your time.
Awesome. Thanks. And like I said, I'll send you that flyer, Dave, and you can kind of distribute that out.
That'll be great. Have a great day.
Thanks, guys.
Right.